All right, since we already started the recording, welcome everybody to another edition of the Microstructure Exchange webinar series. We're very happy to have today David Cimon from the Bank of Canada, and his co-author Mike Brolley is also in the room from Laurier University, both in Canada. So the two of us will talk about their new work on non-bank dealing and liquidity bifurcation in fixed income markets. So very excited to hear from them. Usual rules apply. If you have questions, please put them in the chat. I will either ask you to unmute yourself or pass on the question to the speaker. We will see how this goes. Maybe also Mike will handle some of the questions that can be immediately handled. Otherwise, David has some natural breakpoints in his presentations where we open the floor briefly for questions. With that, David, the floor is yours. Please go ahead.
Thank you very much for having me, and thank you very much for everyone for coming today. We have, I think this is going to be a fun presentation. We've tried to put together a fun little applied theory presentation. The alternative interpretation that we welcome is that perhaps it is an elaborate, if not arcane, April Fool's joke. So if you don't think it's fun, that's the other way you can think about it today. So we are going to talk about non-bank dealing and liquidity bifurcation. This has been a pretty hot topic over the past couple of years in sort of the fixed income and central banking world. And that's how we're gonna start today. The usual central banking disclaimer applies, and we're off. So, looking back into past periods of stress and crisis in financial markets, there is often thought to be a premium to highly rated government fixed income instruments. We can think of US Treasuries, for example, as a source of safety in crises. However, what we have found over the past almost 20 years now since the Great Financial Crisis is that occasionally these do not act so safely during crises. For example, during the March 2020 episode during COVID, there was a sharp spike in the trading cost of US Treasuries during the time when broadly financial markets were in stress. And this spike in the cost of US Treasuries coincided with similar spikes sort of across the Western world and the rest of the world as well, where government debt rapidly, as the COVID crisis onset, became more and more illiquid. There were calls during this time to central banks to free up, specifically to free up dealer balance sheets, which allegedly were becoming clogged with high volumes of fixed income sales from buy-side participants. Ultimately, most central banks engaged in some form of market functioning purchases to get these large quantities of fixed income assets off of dealer balance sheets and free them up. This sort of goes back to the historical role of dealers in bond markets. Often we hear about equity markets. They are probably among the more popular research topics. And, we think of equity markets as these sort of efficient markets. Most trading's on exchange. Intermediation is by a broad set of participants. Fixed income markets have often not followed that same regime. Historically, these markets were primarily intermediated by bank-owned dealers. Now, this has changed in some countries, and we're going to talk about that, but the historic fact is that banks were doing a lot of the heavy lifting here. Post-Great Financial Crisis, regulators decided, for very good reasons, that perhaps it was not ideal for banks to be taking on large amounts of risk on their balance sheet, engaging in sort of prop trading and highly levered activities. And so these regulations, some through the Basel III package, some through the Volcker rule in the United States, put a series of limits on the abilities of bank dealers to intermediate in fixed income markets. One that is often cited as particularly binding is the supplementary leverage ratio, which to some degree limits the ability of banks to arbitrarily expand their balance sheet through the mechanisms that they normally use, like repo agreements. During crises, we often have high volumes of sales from buy-side participants. We can think of these as either participants exiting positions. We can think of these as sales in order to meet margin requirements, or in order for participants like mutual funds to meet redemptions. And in a market that's intermediated by banks, these sales all go to bank dealers. This brings in the sort of long-standing concern that there is a tension here. On one hand, we have good reason for post-Great Financial Crisis regulation. We don't want banks to sort of arbitrarily take on large amounts of risk. We want banks to be safe. On the other hand, the inability of them to rapidly scale up during crises brings in concerns that this is sort of amplifying a different type of risk. And that risk is, their inability to absorb these large sales from the asset management sector. In COVID, this meant that central banks have to step in. But perhaps there is another way. It has been suggested, not just recently, but for some time now, that perhaps an increase in competition might be the answer. If we believe that banks should be more highly regulated, and if we believe that someone needs to absorb this excess inventory in crisis, perhaps it could be non-banks. We know that in some markets, new entrants, primarily principal trading firms and hedge funds, have come in and have acted as significant liquidity providers in electronic bond markets. For example, on TradeWeb and MarketAxess, these are two sort of large platforms that operate in the United States for fixed income markets. We know that principal trading firms play a significant role. And regulators have sort of caught on to this, right? We can look at the SEC reform package in 2023, 2024, that came at this exact question, that said, perhaps if these non-banks are acting like dealers, maybe they should be regulated like dealers so that we have a level playing field. And this generally, on its face seems like a pretty good idea, right? We have participants that are no longer able to perform their role the way they were. We have new entrants. We're going to level the playing field. This is sort of how we like to think of markets a lot of the time. But nonetheless, there have been complaints. Amy, that is the sort of exact topic that we're getting at. You have preempted me. So there have been complaints. If you listen to the sort of large traditional dealer banks, there are consequences to this entry. And the consequences they will indicate look something like this. If we allow these new entrants, then naturally the market will become more competitive, and these large dealer banks will have to scale back their business. That's sort of might be how competition works, right? If we think there's a fixed size to the pie and there's more entrants, naturally everyone gets a smaller amount of the pie. Now you can imagine that the pie might grow, but that's obviously not part of this argument. And if the smaller part of the pie results in less profit to the traditional banks, then just you wait until stress time, they will argue. These new entrants will have no incentive to stay around during stress, and then there will be less bank dealing capacity. This is the argument that gets put forward. And so traditional dealers argue that they are a source of stability, that new non-bank entrants will not provide stability during crises, and that even if liquidity improves during normal times, this will increase stress time fragility, the very issue that non-banks are purported to help with, because that is when banks become strained. So we're gonna try and take this seriously. This is what our paper is going to be about. We're going to put together a model of dealing where non-banks increase competition and they increase the sort of aggregate balance sheet capacity of the dealer sector. And then we're going to ask whether these sort of alleged consequences are possible, under what conditions, who benefits, who suffers. That is sort of the crux of the paper here. So our plan in brief, and I'm going to pause after this if there's any sort of introduction questions, is we're going to put together sort of a nice applied game theory model of financial intermediation. It's going to be a very simple model. There are going to be very few bells and whistles here. We are happy to attach bells and whistles. This is still a very early version of the paper, so we're sort of actively looking for where to take this model right now. But right now it is a very sort of basic model, which is kind of how we like it. There's going to be a bank and there's going to be a non-bank dealer. And both of these participants are going to have inventory costs. We can think of this as some balance sheet capacity limit. They're going to compete to provide liquidity. We're going to have two funding states, which are going to occur stochastically. It is either going to be normal times when the cost to deal is relatively low, or there is going to be a stress time when the cost to deal is relative. Our bank is going to act as an incumbent. This means that they have sort of first right of entry, but they are going to act as a sort of designated market maker type participant, which means once they enter, they participate regardless of the state. The non-bank is going to be offered an opportunistic entry. They find out if the incumbent has acted first, and then they move in. Unlike the incumbent, we are going to give them the power to observe the state before they enter, which means that they can act in sort of good times or bad times, or both, depending on whether they want to. We're going to have a central bank, and the central bank is going to be able to provide funding support during times of stress. And we're going to use that to sort of talk about whether the impact of central bank interventions are as effective under this structure, or whether they lose impact. So this is kind of a good first time for a pause. Any questions, thoughts?
So to what extent do you think, I mean, one of the oddities I always thought of blunt markets is that it is an OTC market, which is, one-to-one, and that there is no organized mechanism for risk sharing. Is that something that will feature in your model? Is that something you've thought about?
Yeah, so that's a great question. Traditionally, of course, yes, bond markets, and I say traditionally, but here in Canada, very much still until today, bond markets have been and often still are a one-to-one. Starting in the past 20 years, we have seen the increasing electronification of some markets. A lot of this has started in, for example, interdealer markets, which both in Canada and in the US often feature more electronic trading than sort of the OTC one-to-one client relationships markets. We're going to have in this model a sort of frictionless, two-sided double auction interdealer market, which we're going to use to think of sort of a more efficient electronic market. This isn't a requirement for the model to work, but we're gonna kind of use that as a feature. As another sort of stylized fact, these non-banks, when we think about them entering in practice, a lot of this is actually on the sort of more electronic interdealer markets, because that's where these guys have the sort of advantage, right? One of the classic requirements to be a dealer is to have a Rolodex full of clients that you can pull out. I need to stop using that as a word, because I realize as sort of younger people enter the field, they may not know what a Rolodex is. But if you think of these more electronic markets that are a little more frictionless, you no longer need that Rolodex full of clients, and that's where these sort of classic dealers lose their advantage, and where these large principal trading firms sort of initially prefer to act. Now this is changing. There was a great article out. It was the better part of a month ago now, that I believe it was TD. I'm going to say TD, but if it wasn't TD, I apologize. Was setting up a principal trading firm style shop to do electronic trading of bonds. So you see some of this filtering back into the bank sector now. But yeah, that was a very roundabout answer to your question.
Okay, so I don't see any hands up. If anybody has a question for now, go ask it. Otherwise, David, please continue.
Moving on. Okay. So the way we're going to start here, as kind of preview, if I run out of time, I apologize. We're going to show that the entry of these non-banks improves liquidity. This is unsurprising, perhaps as economists and finance professionals. Competition is generally good, and more competition often improves liquidity. So they're going to improve liquidity, and they're especially going to improve liquidity in large markets. Large markets which need sort of an excess amount of dealing capacity. We can think of these as, for example, government bond markets. These non-banks in the model are going to enter, and the fact that they act state dependently is not going to have kind of negative effects. And this is going to be good. We're going to see that in sort of more marginal markets, you may have this consequence of bank exit. And that's going to be sort of the teeth here. Whereas non-banks sort of strictly improve things in large markets, in these smaller, more tenuous markets where banks are really acting as marginal participants, this is where non-banks are going to be able to push them out. And we're going to talk about sort of the policy prescriptions around that, how, regulators and central banks maybe should be more concerned about these marginal markets rather than the large, highly liquid markets where our model suggests that there are less likely to be negative consequences. We're going to show that central bank lending during times of stress actually mitigates consequences from non-bank entry. If central banks sort of act predictably during stress, through sort of classic lending type interventions, this encourages banks to remain in the market and may prevent them from exiting marginal markets. We're going to show that central bank liquidity passes through to non-banks through interdealer markets. But if banks are pushed out, this central bank support may be less effective than it had been. There is a wide amount of literature. I'm not gonna belabor this point, but yeah, we're sort of at the intersection here of papers on dealing frictions, papers on all-to-all trading, government bond markets, and central bank facilities. I apologize. There are many people in the chat with good papers on this. I could not include them all on one slide. So I'm going to go through the model in pictures. It is, I think, the easiest way to consume this. For those of you who are more mathematically oriented, I promise that is coming next. But I'm a pictures person, and that's how we're going to sort of go through this first, just to kind of keep everyone on board here. There's going to be a representative investor, and they're going to enter the model with inventory I. And this I is going to serve as a proxy for the total size of liquidity demand in the market. So you can have a small investor. He only has, he's got like one stock certificate here. We can think of like a larger investor. They have more stock certificates, but this I is going to be the key sort of ingredient. The representative investor might be served by a bank. The bank here, we've picked a nice building. The building can't move. The building is stuck there every day. It doesn't get a choice whether it opens or not. If the bank chooses to enter this market and build its bank building, they're there every day of the week. We have a non-bank financial institution. You can think of this as a principal trading firm. Unlike the bank, we can see this one's on wheels. It's a nice little food truck. He can decide whether he's going to show up every day. If it's sunny, it's probably going to be a good day for him. If it's raining, it's not going to be a good day for him, and he's not going to show up. And then we're going to have an interdealer market. The interdealer market is going to serve in sort of a risk-sharing inventory balancing capacity. This is just going to be how participants risk share the inventory that they take on from the investor. Okay, so the investor is going to enter the game at the beginning of T0, and they're going to have this inventory I that everyone is aware of. There's no private information here. There's no asymmetry. Everyone is aware of the parameters of the game they're playing. So before the investor comes in, there's going to be a state of nature. It's either going to be good times or it's going to be bad times. We can think, it's either sunny or rainy. This is either like the normal funding state or the stress funding state. And initially, this is going to be uncertain. We are unsure whether it is a good day or a bad day yet. There's going to be some probabilistic framework around this. With probability delta, it's going to be a stress state. You can think of this as, the chance of a crisis. With probability 1 minus delta, which in practice is going to be the majority of states, it is normal times. These two have funding costs attached to them. We're going to call these funding costs gamma L for low or gamma H for high. Yeah, and this L and H notation we're going to carry throughout the paper. Low cost states are always going to be denoted L. High cost states are always going to be denoted H. The first thing that's going to happen is the bank's going to choose whether to enter. It has to do so before this probabilistic state has sorted itself out. So if it enters, it has to act regardless of what this state is, because it makes its entry decision before the state realizes. Once it chooses whether to enter, it becomes attached to the client market, and then we move to the next period. The first thing that happens is the state realizes. I've picked the sun because I like to think it's a sunny day, but we could imagine that it instead turns into a stress state. The non-bank is then going to, number one, view the state. Number two, view the entry decision of the bank. And then it is going to choose whether it also enters the game. It has the option to enter regardless of whether the bank has entered or not. If the bank has not entered, it becomes a monopolist. If the bank has entered, it can enter and compete with the bank. But either of those are on the table. And so then we think that the non-bank has entered. And so we have a client market that's served by two dealers in this case. We then move to the trading stage, T2. In the trading stage, the bank and the non-bank are going to compete for this client order flow. They're each going to take some segment of it. And then they're going to risk share on the interdealer market. We're going to introduce another participant on the interdealer market, which is just a representative dealer. They're going to absorb inventory from this bank and non-bank in order to sort of balance out flows. You can think of this as representing the sort of aggregate risk-sharing capacity of the dealer sector. Again, this is sort of an automaton. It's not a key ingredient of the model. We're going to kind of hand wave that for this presentation. And so that's the nice pictures. Mathematically, here is what we're going to be dealing with. There's going to be a tradable bond, which I talked about. There's going to be a client and a dealer market. In the client market, the investor may trade the bond with the dealers, who are going to act oligopolistically. In the dealer market, the dealers are going to trade the bond on an interdealer market platform, and everyone on that platform is going to trade efficiently as price takers. The quantity I is going to represent the total size of the market. Holding cost is costly for all the dealers. We're just going to use linear quadratics so that we can have sort of nice analytics solutions. There's going to be this probabilistic state that I mentioned. With probability delta, we're in stress. With probability 1 minus delta. There's going to be a representative investor who's going to be the total liquidity demand. They can sell the bond into the client market at some spread. This spread we're going to denote SC for the client market and the state I. With apologies to Josh and Marcus, we've cribbed some of their and Bart. We've cribbed some of the notation from their paper. We really liked it. So thank you to you guys for having good notation. Where the investor is going to have a profit from trading, which is going to be the spread they pay in the client market minus some total cost that is quadratic in their inventory. So the investor has a higher motivation to sell if their inventory cost is higher, and they prefer to sell if spreads are low. They are I guess, loss minimizer formally, but that's the same as a profit optimization problem here. So we're just gonna kind of move past that. The investor is going to be a price taker, so they're going to select X as a function of the spread to maximize their profits. This is public knowledge. Again, there's no information. The bank dealer is going to be aware of the investor's optimal X, and they're going to have the option to pay a one-time entry cost lower C to enter the market. If not, they lose the game, or they leave the game. You can think of this C as the sort of total aggregate cost for a dealer to enter a new asset market. So for some markets, this may be very high if you require a lot of infrastructure. For some markets, this can be very low if, for example, it's just, uncleared OTC trading. After the entry decision, the bank is going to view the state as either normal or stress. We've chosen green and red to represent those for, I think, the obvious reasons. And then the bank is going to optimize or maximize their profit function. It's going to be the spread they earn in the client market times the amount they trade minus the spread they pay in the interdealer market times the quantity they trade minus their total balance sheet funding cost, which is going to be quadratic in their net payment. In each state, the bank selects a quantity Xi in the client market and a quantity Qi in the dealer market to maximize their profit. And they know the state before they select these quantities. So they're only entering before the state is known. They know the state has realized before they select their quantities, right? The non-bank dealer is going to be an opportunist. So they view the state, they view the bank's entry decision, and then they are also offered the same opportunity to pay a one-time entry cost. Their profit function looks exactly like the bank's profit function. They earn a spread in the client market, they pay a spread in the dealer market, and then they incur a funding cost. So the essence of the game here is the entry game between the bank and the non-bank. In the baseline model we propose here, there's no functional difference between the bank and the non-bank other than their entry timing. We're going to expand this with the introduction of the central bank and in an appendix about differential funding costs. But in the base of the game, these are going to be identical entrants except for the order of entry. There's going to be a representative dealer in the IDM market who absorbs inventory. I already mentioned this is just an agent to sort of represent the inventory management capacity of the dealing sector. They're just going to submit a quote into the interdealer market in order to risk share with the other dealers. They're going to act fairly like an automaton, so I'm going to kind of gloss over that. And this is kind of the extended form game written out, right? There's kind of two sub games here. The first is the entry game, and the second is the trading game. And we're going to solve these through a normal backward induction type framework. In the trading game, which happens second, the bank and the non-bank are going to submit quantities to the client market and interdealer market respectively, and these are going to clear at spreads which clear the market. And then we move back into the entry game. The bank enters, the state realizes, and the non-bank enters. This is all a sort of basic extended game. Here's an equilibrium definition. You're free to look back at this later if you're okay. Any questions on the model before we sort of move forward?
I have a quick question.
Yep.
Hi, yeah, thanks. Could you maybe elaborate a little bit on how you're interpreting the like economic interpretation of this difference in entry, specifically on the dealer side, the bank dealer side, if they're kind of committing, they're making some commitment to be in. Are we thinking about this as, say, like a legal obligation to make markets as they have for some like primary dealers? Or is this something that is generating some like benefit from them elsewhere? For example, preserving relationships with their clients. How should we think about that?
So you've actually hit on my two examples right there. So I'm coming from a central bank, so I think of this in our own primary dealing framework. And you're correct. Many central banks, the Bank of Canada included, have some requirement on primary dealers or whatever their name for primary dealers is to make markets. So that is certainly one way to think about this. Central banks require their dealers to make markets during times of stress, even if perhaps they wouldn't want to. An alternative, I'm going to talk about this at the end if we have time. An alternative to that is that if we think of primary bond markets, and we're going to argue that this model can be interpreted as like a primary issuance story too. In primary bond markets, central banks often have explicit bidding requirements for bank dealers. If you want to act as a primary dealer in central banks, you are often required to bid. And so, yeah, that we can think of as the legal obligation end. The other end of this is that often, as you suggest, there is a client services element to this. If you are a large bank and you have clients, it would be unusual for you to tell them, we simply do not deal in government bonds anymore. A lot of clients are going to expect that as part of a full service dealing relationship, right? Now, obviously, there are cases where during times of stress, banks say no to clients. We know this has happened. This is not like a hypothetical. However, there is a more of a relationship preservation angle, which is, I think, exactly what you suggested. So yeah, I think you're on the mark with that. Yeah.
Thanks.
Sorry, I have difficulty navigating my mouse. I don't see any other questions, neither in the chat, so maybe just continue then, Mike.
Yeah.
David, sorry.
Keep moving on. So the first thing we're going to do is we're going to look at the second sub-game. That is the trading game. So we're going to take entry as given, and we're going to look at states where the bank enters, states where the non-bank enters, and states where they act competitively against each other. So within the second sub-game, entry by the non-bank increases competition. Just that is a blanket result. If the non-bank enters, given the decisions have already been made, positive market impacts occur. Compared to when only the bank acts, when the non-bank enters, volume in the client market increases, so asset managers receive more service. Volume in the interdealer market falls because there is less need to risk share. Dealers retain a larger percentage of their inventory because each of them is taking on less inventory. They're able to retain more of it, and they need to risk share less of it. So this would mean that principal trading increases compared to agency trading. We often think in fixed income markets that principal trading is more costly because it requires the bank to take on inventory onto their balance sheet. But in this, because of the competitive impact, spreads are actually going to fall. So within the second sub-game alone, non-banks are strictly beneficial. If we are looking ex post at markets where non-banks have entered, conditions should improve, which is good. That's what we want to see, right? We may, however, see liquidity bifurcation. And this is the worry. So we're going to define liquidity bifurcation within our model. This is not the only possible definition of liquidity bifurcation, but given we have fixed variables in a model, we need to write down something. So in our model, we are going to say liquidity bifurcates when the ratio of stress time volume to normal time volume falls. So if we think there is, the amount that gets traded during stress versus the amount that gets traded outside of stress, if that ratio goes down, we're going to say liquidity bifurcates. Alternatively, we are going to say liquidity smooths if that ratio goes up, which is to say it approaches 1. So looking at the entry game rather than the trading game, we're going to show that liquidity bifurcates if the non-bank enters only in the normal state. Liquidity smooths if the non-bank enters in both states. That's going to be sort of applying the entry game to the trading game. And so we're gonna take that and we're gonna look at the states where liquidity bifurcates. Bifurcation can be good, as it turns out. Liquidity can bifurcate, and it can be good if the investor is no worse off than they would have been before. We can think of this, for example, if the non-bank enters, but the bank still enters. So now we just have more dealers. Trading becomes more variable, perhaps, but everyone is still better off. Bifurcation can be bad, what we call harmful bifurcation, if the investor is worse off in at least one state. And this harmful bifurcation is sort of the allegation that traditional dealers make. So this is important for sort of an empiricist who might be looking at this problem. Because if you look at this problem empirically, what you might say is, for example, we're going to look at the difference in trading volume between markets with non-banks and markets without non-banks. That's sort of a classic empirical question you might ask. And if you find that that diverges, we're going to argue that can be a good divergence or that can be a bad divergence. And so just the fact that liquidity diverges between good times and bad times is not necessarily harmful, is going to be our message here to the empiricist. We're gonna show in the model, and I'm gonna save everyone the math for this presentation. It's in the paper if you really want to look at it. We're gonna argue that beneficial bifurcation can occur in large markets if the investor's inventory is sufficiently high. Liquidity will bifurcate because non-banks will enter during normal times, but everyone will be better off. And so this is beneficial, but it is still nonetheless a liquidity bifurcation. In very small markets that were unserved by bank dealers, so we can think of these as like very thinly traded corporate debt, especially high yield corporate debt. In some jurisdictions, we might think of this as like thinly traded municipal debt. Banks may not have traditionally served these markets. Non-banks may come in and serve these markets opportunistically, and that's also going to bifurcate liquidity, but it's going to be good for everyone. So we argue that even if you see diverging liquidity, it might be good. In large markets such as Treasury, this is because of benefits from competition. In small markets, this might be because non-banks enter new markets that sort of were previously unserved. If you really want to see this sort of graphically, and I promise for the next version of the paper, we're going to have better pictures. I made these pictures. I'm not good at making pictures. Mike's the pictures guy. He's going to make nice pictures for the next one. That's the crux of this. On the x-axis here, we have the initial inventory. On the y-axis, we have traded quantity. If you look at a baseline model in blue where only the bank's allowed to enter, normal times are on the left, stress times are on the right. We can see that for very small inventories, the non-bank enters before the bank would have, that's because it can enter in only normal times if it chooses to do so. So it can enter opportunistically for very small markets. For sort of middling markets, there's no improvement. And then for very large markets, liquidity bifurcates, but everyone is better off. And so the interpretation here is that for some markets, this is strictly beneficial. Tommy.
Hey, it's been a while.
It's been a while. How are you doing?
Yeah, good. You look good. Okay, so just I had a random thought, which is in these small markets, say corporate bonds, and we're thinking about these guys who are opportunistically entering to make markets. Yeah, I'm just having a hard time understanding how these guys even, so they're out, they're not providing liquidity, and all of a sudden they see that it's good times and they're going to enter and provide liquidity. Like, where do they find these corporate bonds and where do they find the inventory to make markets here in practice? Because in these markets, there's no shorting, there's no, like you just don't have the inventory of random corporate bonds sitting around. So here I was just, yeah, how am I supposed to think about that in the small markets?
So we're thinking of this rather than providing bonds, we're thinking of this as in sort of absorbing bonds from the market. So I guess to flip your question around, this would be more about them being able to offload inventory afterwards, rather than sourcing inventory, right? In terms of sort of, where they would find clients, I think is probably the secondary question to that, right? And you do have out there these sort of small scale electronic all-to-all platforms that exist and that these principal trading firms are active on. And that's kind of how we think about this. These are not in these very small markets. These are not big trades, right? These are small trades on small markets, which is why we think of like sort of municipals or like high yield or something like that. We're not talking about big like 50, 100 million more like size treasury trades here. But yeah, we're to go back, we're very much thinking of this in them absorbing inventory rather than putting out inventory. I think, as you suggest, the story's a little bit less plausible in the other side. Yeah, totally agree. Yeah. So cognizant of time, I've just been talking everyone's ears off. Harmful bifurcation, we're going to argue, can only occur in a very narrow game theoretical sense, which is going to sort of pin down the exact circumstances under which this story from banks where they're just going to exit the market and stress is going to happen and everyone's going to be worse off. This is going to, in a game theoretical sense, pin down when that can actually occur. And in our model, which is, again, a very stripped down basic model, you need an overlap of two best response functions. You need to have the bank entering only if the non-bank will not enter. Okay, that's condition one. And then the non-bank entering if the bank enters, and if the bank doesn't enter, but only in the normal state. So this is a sort of convoluted intersection of best responses that have to occur for harmful bifurcation to be possible. In our model, you can parameterize this, in fact. And the parameters that this occurs under are this nice little equation here, which we're gonna write this out. So the interpretation here is if the bank's oligopoly profit in normal times, so that's the bank competes with the non-bank during normal times, is greater than its monopoly profit if it was the only entrant during stress, harmful bifurcation can occur. And what this means is the non-bank pushes the bank out. The bank sees the non-bank's going to enter and it says, nope, I'm not going to enter. The non-bank then enters and says, I'm only going to make markets during good times. That is when harmful bifurcation occurs. In our model, this is a very narrow window. It is difficult for this to happen. And this window occurs not at the high end, where bifurcation helps markets, not at the low end, where banks weren't entering in the first place, but in a sort of narrow middle set of markets.
And if I can interrupt you there for a second, David. I mean, theoretically, and in the context of your model, you say it's small, but empirically, this could be everything, right? So that's kind of the big question that you have to answer, actually, right?
It could be, but we can look at the sort of predicted entry game in normal times, and we can say that we're not in that regime, right? Because in our model, the entry game in normal times, if we look at treasury markets, for example, have banks and non-banks in them, right? That is the realized equilibrium there. In our model, you don't get to a stress time flip of that, where all of a sudden everyone's gone during stress. Sort of ex post in our model, we can look at the normal state and say this is the inference. Where one would be concerned in our model is to look at the normal times, which I'm going to boldly say we're in normal times right now, but maybe. I'm
just saying, I mean, if you are a regulator and if you're particularly in the stability business, then you worry about this, what you perceive to be an edge case, right?
Yes. I don't disagree with you, but if we're interpreting the model, the markets where there is a problem are the ones where the bank gets pushed out in normal times and where the majority of dealing is now being done by non-banks. That's where the problem is. And so those are where in stress times, which hopefully we don't observe for a while, that's where you interpret there to be a problem. That has happened in some markets, and that is perhaps where the worry should be. That's the argument we're going to try and make here. Again, I've sort of run over, so I'm gonna sort of just breeze through and hopefully just end less than 5 minutes quick. We allow for a central bank. The central bank is going to come in as an automaton and replace the dealer's funding costs during stress with its own, which we're going to denote gamma CB. This gamma CB is going to be on some interval that is less than the stress funding cost, but greater than or equal to the normal time funding cost. This is going to smooth profits between states and increase the bank's willingness to stay in. We show that in the presence of non-banks, the pass-through of these central bank interventions decreases, which is to say the ratio of volume when the central bank acts versus when it doesn't act falls, which is, it's not to say the central bank doesn't have an effect, but it has less of an effect when non-banks are entering. On the other hand, the central bank can prevent harmful bifurcation. It can flip the relationship from proposition 2, which means that if the bank would have stayed out, the presence of a central bank can keep the bank in, which means that this same harmful side effect doesn't occur, which is good. So there's a trade-off for the central bank. On one hand, it can keep banks in the market. On the other hand, if non-banks are present, the pass-through of its interventions may be. In the paper, we have a section where we reinterpret the model in the context of primary issuance, which is to say, rather than an investor, we have a bond issuer who wants to issue a bond. The dealers then pass that bond on to the broader market. If you interpret the model in this way, the entry of non-banks may help very large issuances and very small issuances, but marginal issuances may see harmful bifurcation in their markets. We have seen non-banks enter in primary in a lot of jurisdictions. For example, in Canada, we have non-banks that act in our primary markets. And so this is sort of a chief concern, especially for central banks. We have some extensions where we talk about central bank lending to non-banks. As a quick plug, myself and other staff at the Bank of Canada put out a discussion paper on central bank lending to non-banks last week. If you're interested in that topic, it's a fun policy read. We also talk about non-banks with lower costs of inventory. We show that if non-banks have just lower inventory costs, they outcompete banks in every way, and that actually the market may just be better, which is unsurprising. And that's it. Sorry for running over. I apologize. We think this is a fun little game theory model of non-bank dealers. We argue that these non-banks increase competition. We argue that in very large markets, non-banks sort of first order improve things by improving competition, but that there may be problem in more marginal markets where they push sort of classic bank dealers out. I breezed over it, but we show that central bank actions remain effective and may prevent banks from leaving the market. However, pass-through is slightly decreased. So central banks may need to have sort of larger interventions to show the same degree of improvement during crises. Thank you very much.
Well, thank you so much, David. We have a few more minutes for questions. So I invite others to step forward.
Maybe I'll just hit Peter's statement in the chat, because that I think is a good point. So, you know, Peter writes that hedge funds used to raise money predominantly from rich individuals. Nowadays, they raise money predominantly from large financial institutions, so they're not independent agents. This is, I think, a very important point here, right? And this is why in our model, we have the non-banks subject to the same funding constraint as banks, as sort of the base constraint. If we think of sort of, and I'm going to use the word old-timey, hedge fund that is sort of, you know, relying on some large pre-committed pool of capital, then they may not have higher funding costs in crisis if that funding's all locked in, right? What we're thinking of here is a non-bank that is, you know, probably levered using repo, and where that cost is also going to scale in crises. And that cost is going to scale at the same time that the bank's funding cost is scaling in crises. So we are very much thinking of like a modern hedge fund here, rather than just a big pool of money. Yeah, so that is a really key point. Yeah, thank you for that.
So if I may ask maybe more of a summarizing question here, right? So, I mean, you know, your model is obviously a game theoretic model with a number of frictions built in. So in terms of the big constraint and the big problem that arises is that seems to be a missing market mechanism, right? Or a missing pricing mechanism, right? Because, okay, so in times of stress, it becomes more expensive to fund, and somehow people want to get out of their positions, not at the price that they want to get out of, right? So there seems to be some fundamental discrepancy here. So what is really the key driving factor, if you would say, that in terms of the modeling and in terms of a friction that is built into your market and also into the market as it exists, that drives that result?
Yeah. So to me, I think the key friction, and this is present in the model, and it's also sort of in practice, is you can't become a dealer tomorrow, and that's really it. If I'm sitting on March 11th in 2020 and the COVID-19 crisis is happening, I can't pick up my phone and decide, you know what, all the dealers are out of balance sheet capacity. I'm not a dealer, but I'm going to become a bond dealer today. That is not something that you can scale up arbitrarily during stress times. And it is probably not a profitable business to sit around not dealing and wait to scale up in stress times either, right? It is a low probability event. It is unpredictable because of regulators and central banks stepping in to alleviate stress. And so you have this sort of pre-commitment problem where these large entities have capital locked up for various business functions, and they can't arbitrarily release it. Now, regulators attempt to deal with this in various ways. We can think of, for example, at the start of COVID-19, OSFI, which is our banking regulator here in Canada, modified the supplementary leverage ratio. And so at the beginning of COVID-19, it was such that central bank reserves, we call them settlement balances, but central bank reserves, and government bonds no longer counted towards your leverage ratio in Canada. So this allowed banks to scale up their balance sheet in a way that they previously weren't able to. Now, as the crisis ended, those exemptions rolled off, obviously. But without regulators taking action, you have these sort of scaling frictions like that, and we sort of see that as the fundamental issue. Yeah.
So I mean, if I could put this, not to find a point to it, the core problem is really the initial regulatory constraints that are put onto the market, right?
But again, there's good reasons for these, right? Like we don't want large dealer banks arbitrarily scaling their balance sheets day to day. We found out how that turns out. So there's a trade-off here, obviously. Yeah.
Josh.
The talk. Here's one thing that I didn't quite get, and maybe it connects to some of the things that you were just saying to Andreas, but I'm still a little fuzzy on. So the non-bank, you talked about how it might enter during normal times and not during stress times.
Yeah.
But can it ever go the other way around in your model? Because I would have thought intuitively during stress times, that's when the investor is really desperate to trade. So maybe this is actually a good time to be entering and providing liquidity.
This is a great question. So the way we've parameterized the base of the model right now is we've focused on a pure funding stress, where the only stress that occurs is dealers now find it harder to deal. In practice, we have largely covariant stresses, right? At the same time that dealers are finding it hard to deal, everyone else's balance sheets are also taking a beating and they want to sell. So there's more client demand. So, I mean, the simple answer is within the model, the non-bank is free to enter state dependently in normal times and during stress. If we are only dealing with funding stresses on the dealing sector, it is only ever optimal for the non-bank to enter in normal times or always. However, if you create a covariant shock, which we haven't included it, but we have done it out. You can have, if asset sales increase at the same time funding stresses increase, you can have it be more profitable to deal in stress times. That is, and in that case, the non-bank will enter preferentially in stress times. That is a perfectly valid sort of modeling outcome. What that does not generate is harmful bifurcation. Because if non-banks preferentially enter during stress times, that's good, right? That's good for the market. So in fact, in order to get this alleged consequence, which is this harmful bifurcation, these stress covariations can't be present or have to be present in very limited degree. If we think those things both happen at the same time, then this isn't a plausible story. So yeah, you've hit the nail on the head there. Yeah.
All right, very good. Well, this puts us exactly at noon, according to my clock. And so thank you so much, David, for your great presentation, and also Mike for being here. I promise not to mistake you again. And yeah, so thanks everybody. And we have another talk in 2 weeks from now. I actually forgot who it is, so I apologize. And I see you then. Thanks for coming.
Thank you very much, everyone.